What the heck'em happened? Welcome to this week's edition of Friday's Food for Thought. Now, I'm sure I'm not alone in thinking, what the heck happened to the reverse mortgage program? And it's only natural to find yourself pondering this quandary if in fact you've been originating the federally insured reverse mortgage for 4 years or longer. Now, while asking the question will not change anything, we can in fact put the puzzle pieces together with a short retrospective. So let us take a short trip down memory lane. 2005, a year after creating guidelines for refinancing the HECM loan, the first reverse mortgage refinances hit the market. It was a boon for lenders and borrowers alike as home values were appreciating rapidly, much too rapidly in hindsight. 2006, after years of struggling with county-by-county lending limits, a national lending limit was established at $417,000. This was an immense help to borrowers with higher valued homes in counties where the average home value was much lower, and this allowed them to substantially increase their benefit. Now, in an appreciating market, that risk was negligible. 2008, there were headwinds indicating the possible slowdown in the housing market, but the crisis had not yet revealed itself. This year brought us the widespread adoption of the fixed-rate reverse mortgage made possible by Ginnie Mae securitization. Now, the trade-off was that borrowers were required to take all available funds at closing, regardless of their need. During this time, the average age of the reverse mortgage borrower continued to drop further, and that increased risk to the FHA insurance fund. Also not to be overlooked was the SAFE Act introduced in 2008, and it created new licensing and education standards for originators. Also, limits were placed on the maximum origination fee that could be charged on a HECM loan. 2009, the country finds itself in the full throes of the housing and economic meltdown. Housing values plummeted, foreclosures skyrocketed, and HECM lenders, they scrambled to find their way. Nervous investors also walked away from proprietary reverse mortgages, effectively ending reverse jumbos. Now, ironically, in the midst of the housing collapse, the HECM for Purchase program was introduced, eliminating the need for two mortgage transactions for those seniors who were seeking to finance their new home with a reverse. Also, not surprisingly, HUD reduced lending ratios or principal limits by 10% across the board. Now, it also increased the national lending limit during this time to $625,500, and that was while home values were dropping. 2010, to save and cost more, HUD introduced the HECM Saver, which offered substantially lower upfront insurance premiums in exchange for access to less funds. Conversely, while lowering premiums for the Saver, FHA did increase the upfront insurance premium from 0.5% to 1.25% for the standard HECM. 2011 through 15, the changes keep coming, with first-year distribution limits, two-tiered FHA insurance premiums, the arrival of the CFPB, new non-borrowing spouse policies, and yes, the financial assessment. It's clear to see that the days of easy lending are far behind us, yet the HECM program remains. HUD and FHA have taken to heart the phrase, adapt or die, and consequently, we have a more restrictive and targeted product. Yes, we can all certainly lament several of these changes, but looking back, we may be able to answer the question, what the heck happened to the HECM? Now share your thoughts below and have a great weekend.